Quick question before we start. How many funds do you think you actually need to begin investing? 5, 10, a whole spreadsheet full of tickers. Here's the truth, you need one, maybe two, or just a few. That's genuinely it. Over this 4-part series, I'm going to walk you through exactly what your portfolio should look like, not just today, but at every stage of your life from your very first investment to the day you retire. And we are starting today with the version that's a lot simpler than most people think. Why people overcomplicate this? Here's something I see constantly. Someone's ready to start investing, they open an account, maybe Sarva, maybe IBKR, and within a week they have got 15 browser tabs open comparing 40 different ETFs, sector funds, country funds, thematic funds, dividend funds, and 3 months later, they are still haven't invested a single dollar. That's not a strategy problem. That's a paralysis, and it's the single biggest thing standing between people and actually building wealth. Not picking the wrong fund, just never starting. Congratulations, you have become a fund analyst without ever buying a single fund. When you are just starting out, only two things matters. Number one, consistency, getting into the habit of putting money in every single month, rain or shine, market up or market down. Number two, having one, maybe two genuinely solid funds, not diversification for the sake of diversification, just something broad, something reliable, something you don't have to think about too hard. If you are going with a single fund, the two most common starting points are an S&P 500 fund or a Nasdaq 100 fund, and which one fits you comes down to risk profile. The S&P 500 is broader, 500 of the largest US companies across every sector. It tends to be less volatile, which makes it a genuinely solid place to start if you are not sure how much risk you can stomach yet. The Nasdaq 100 is more concentrated, heavily weighted towards tech, and by design, it doesn't even include financial companies. Historically, it's delivered stronger returns, but it swings harder in both directions. It is a completely reasonable choice if you have got a long horizon and know you can handle the ride. Just don't pretend the volatility isn't there. Here's what actually interesting once you put these two side by side. Everyone assumes the S&P 500 fund is a way more diversified than the Nasdaq fund. And sure, on paper, one holds 500 companies, the other just 100. But look at the top. Three names in both on screen: Nvidia, Apple, Microsoft. They take up roughly the same slice of each fund. Turns out, diversified and not obsessed with the same five tech companies aren't quite the same thing. Where the two really pulls apart is the rough years and the strong years. Look at the year by year numbers on screen. In the down year, the Nasdaq fund fell noticeably harder than the S&P 500 fund. Then in the very next year, its recovery was very stronger too. That's the trade. Off in one picture, rougher downturns but a bigger snapback and stretch out since each fund's inception. That gap compounds into a meaningfully bigger number for the Nasdaq side. Worth noting, the S&P 500 is also the cheaper of the two to hold every year, which adds up over decades, even if it looks like a smaller number today. So, which one's the better? Neither. It comes down to whether you can stomach the rough years to get the extra reward in the good ones. If you would rather not choose between the two, you don't have to. Split your money across both in a proportion that matches your risk profile. More conservative, weight it towards the S&P 500. More comfortable with the swing, tilt it toward the Nasdaq. Either way, this gives you a front row seat to how these two indexes actually behave before you add any more complexity to your portfolio. For platforms, I would point new investors towards something like Sarva or Vayo. Both have genuinely easy to use apps and you can be up and invested in minutes. No need to understand fund domicile, tax structures, or brokerage mechanic on day one. Sarva is also started offering UCITS, Ireland domiciled option now, which is worth knowing if there's already a priority for you. It costs a little more, but it's ready made if you want it from day one. But here's the honest truth. Your job right now isn't to optimize every basis point of cost or tax efficiency. Your job is to start and to stay consistent. The optimization comes later, and we'll get into exactly that in part 2. Quick mention before we move on. There's an entire community, the Bogleheads, built around an even simpler idea. Pick one all world fund like VWRA, invest every month, and ignore everything else for decades. Genuinely, there's nothing wrong with that. If low maintenance and solid but average returns sound perfect to you, that's a completely legitimate way to invest. Probably the right one for a lot of people. It's just not the path this series is walking, because we are going to explore how portfolios evolve for people who want to understand more, not less. So that's part one. One or two funds, real consistency, and a simple platform to get moving. But what happens once that portfolio actually starts growing? At some point, the question shifts from how do I start to how do I make this more efficient? Different platforms, fund domicile, even estate tax questions once you are investing in US markets. That's exactly where we are headed in part two. Hey, if you are new here, I am Siddiq, and this channel is about helping NRIs in the Gulf build wealth sensibly without the hype. If this was useful, hit subscribe so you don't miss the rest of the series. I'll see you in part 2.